Hello, I'm Steve Cress, head of quantitative strategy at Seeking Alpha, and I'm joined today by our quantitative strategist, Emma Johnson. Thank you so much for attending this presentation on three beaten down stocks ready to rally. This is a technique that we've used a couple times and it's worked fairly well. Stocks with excellent fundamentals that have lagged the market, have softened, and after a couple quarters have rebounded and rewarded investors. So we want to tell you a little bit more about our idea, but before that, I have to do a little housekeeping with our legal disclaimer. We are not advising you personally concerning the nature, potential value, or suitability of any particular security. You alone are solely responsible for determining whether any investment security strategy or any product or service is appropriate or suitable for you based on your investment objectives and personal and financial situation. This presentation is for information purposes only. Content is presented as of the date published or indicated and may be superseded by future events. It represents my opinions, which may not reflect the views of Seeking Alpha as a whole. Past performance is no guarantee of future results. Seeking Alpha is not a licensed security dealer, broker, U.S. investment advisor, or investment bank. Thank you so much for your patience during that disclaimer. A little bit about my background. As I mentioned, I'm the head of quantitative strategy at Seeking Alpha. I've been in the investment world for almost 35 years now. The bulk of my career was spent at Morgan Stanley, where I worked for 13 years. I ran a proprietary trading desk in quantitative strategies. After that, I also was the head of international at Northern Trust, which was one of the largest asset managers in the world. And after that, I founded a hedge fund based in quantitative strategies. And I also started a fintech company based in automated quantitative investment research, which just so happened was purchased by Seeking Alpha. And part of the deal was for me to integrate the technology into their platform. And I liked it so much, I stayed with the company. So it's a little bit about my background. Emma, can you share a little bit about your background?
Thanks so much, Steve. Quite the resume you've got there. For folks who aren't familiar with me, I'm Emma Johnson. I'm a quant strategist here at Seeking Alpha. I've been with the company about a year and a half now. I contribute to our Alpha Picks research service as well as the Pro Quant Portfolio Research Service. I have about 8 years in the industry, previously having worked at an asset manager focusing on systematic equity strategies, so quite similar to what Steve is doing here in the quant world. And I also contribute to premium webinars and articles as well. So happy to be here today.
Thank you for being here, Emma. So our presentation today will cover why quant. We will also go into the pull and push factors driving the market currently, and then obviously get right into the three beaten down recommendations that we have. So starting with what is quant? Quant is a data-driven process that uses math and algorithms to identify investment opportunities. Now, having said sort of a short version of the scientific description, I will tell you quant is really very, very similar to what fundamental analysts would do at Morgan Stanley or Goldman Sachs or Merrill Lynch. We take the basic principles of investment research. For us, those basic principles would be a GARP strategy, where we look at growth at a reasonable price. We add a little plus to that because we also on our quant product, we look at momentum and we look for positive analyst EPS revisions. But basically what that comes down to is we're looking for stocks that are collectively strong on investment fundamentals, being value, growth, profitability, as I mentioned, EPS revisions, and momentum. For the most part, if you have an investment research analyst, they're definitely going to be focusing on a valuation framework for a company, its growth, and its profitability. The difference really between what we do with quant and an investment analyst is an investment analyst really only has capacity to cover maybe 15 to 20 stocks and really can probably only write a few articles a month in depth on any one stock to give a directional recommendation. The power of quant is that we take those investment characteristics and through the power of computer processing, we have the ability to basically research every investable stock every single day with a fresh directional recommendation. So we literally in our system, we go through cash flow statements, income statements, balance sheets, hundreds of financial metrics, and we score it for each stock relative to its sector. That's the power of computer processing. And as a result, we can rank stocks 1 through 5,000, and we could sift the strong companies from the weak companies using a data-driven process. So that's a little bit about what quant is. And we have a fairly good track record. Not all quant models are the same. Some tend to focus just on value, some just on growth, some just on momentum. As I mentioned, we use a GARP approach, which is growth at a reasonable price. And this is our 5-year track record. You could see, and what we have here, this is itself, what you're looking at is the performance for all our quant strong buys every single day, being rebalanced every single day. And we use that same principle for Wall Street analyst recommendations. We refresh the portfolio every day with all the recommendations coming from Wall Street analysts, and we're looking for their strong buys. And we're taking the performance of both and comparing it to the S&P 500. And as you can see, our quant strong buys over a 5-year period are up 250% versus the Wall Street analysts, which are up 54%. And the S&P 500 is up 80%, actually beating Wall Street analysts. So I think Wall Street analysts find it very hard to compete with the S&P 500, but our quant system has no problem crushing both, as you could see. So a little bit about where we are today in the market with the push and pull factors that have put us into sort of a no man's zone right now. So if we were looking at the markets, obviously the Nasdaq and the S&P 500 and the Dow in recent months has hit an all-time high. So they continue to hover near an all-time high. And I think what we point out here is October 8th was actually that date. The rally has been driven by the AI boom, which is fueling demand across the supply chain and broad optimism as well that the Federal Reserve will continue to take rates down. So historically, markets do tend to do well during periods where there's an extended cycle of rate cuts by the Fed. So on top of that, we also, as I said, from a technological perspective, we have an incredible revolution occurring with AI. Market expectations are for an October rate cut. And this is supported basically by a weakening labor market. The concern, from the Fed for the most part over the last several years has been inflation driven. But with the labor market weakening and seeing continued signs of that, there is a fairly strong indication that the Fed will reduce rates. And we see this through how interest rate traders are sort of forecasting what's going on as well, that so many are expecting a rate cut. Taking us to our next slide. We use the CNN Fear and Greed Index here. And as I said before, even though the market is hovering near its all-time highs, the CNN Fear and Greed Index has moved actually from greed territory to last week. It was in a neutral zone. I think in the beginning of this week it hit fear and now continues to descend deeper into the fear zone. So there are a number of factors out there that are creating concern amongst investors. One, President Trump's new tariff threats. If you were looking at the market on Friday, you probably saw that there was a big pullback. These tariff threats, in addition to sort of the rare earth export tensions that are occurring between both countries, helped attribute to that sell-off and continue fears on the part of the market. Also, the government shutdown is a cause for concern, as obviously that could negatively affect and impact GDP. And chances are, the longer that this goes on, the more that sentiment will be impacted in the market in a negative manner. If this was something that were to last a week or 2 weeks, historically, it really does not have a big impact in the market. But the longer it goes out, the more of a negative impact it can have in the market, and the more concerned investors become. The recent sell-off marked the market's worst day since April, and that was on Friday, signaling investor sensitivity to the policy shocks and the geopolitical risks that are at hand right now, contributing to the push-pull factors. So markets are split. Elevated demand for safe havens is continuing to grow. The 10-year Treasury yield dropped from around 4.14% October 9th to 3.99% as of October 16th. So that may not seem like a big move, but the rate of change is something that's raising eyebrows. And it does definitely reflect a flight to safer government bonds amid these escalating tensions. And obviously, gold has been soaring as well, which is another safe haven. So between the 10-year Treasury yield dropping and gold, it's very obvious that there is a move into safe haven. And actually, going to take us to our platform really quickly, so we can look at market sectors. If you're ever on Seeking Alpha Premium, we have this great page, which is market data. If you go to the left-hand navigation, you'll just see market data there. And there are all kinds of different strategies that you can bring up. Here, I'm just looking at the sectors. And if I look at the sectors over the course of the month, you can see the performance here. Utilities, which is traditionally a safe haven sector, and healthcare, which is traditionally a safe haven sector as well, have outperformed over the last 4 weeks. You can see at the very bottom, communication services and consumer discretionary, which were strong leaders for the better part of 52 weeks, are the worst performers over the last 4 weeks. So if I go to the last 3 years, you'll see technology, communication services, industrial, and consumer discretionary on the top of that 3 year performance. If we sort it by 1 year performance, you can see it's virtually the same with those four sectors leading. Now, of course, 4 weeks can't determine anything, but you can see that there is a bit of a shift between utilities, healthcare, gold, and treasury yields falling. There is a bit of a rotation that is occurring. I'm going to take us back to our slideshow. And potential tripwires that are out there. So while the market has shown exuberance and it is hovering near its all-time highs, there are potential tripwires. One could be that inflation tends to stay sticky, and if tariffs do have an impact on inflation and it comes in higher than expected, the Fed could delay cutting rates, or basically the language that's been coming out of the Fed could cease. I think that's fairly unlikely from what the Fed is saying because of the concern over labor. But of course, tariff pressures are just really kicking into the markets now, and there is inflation out there. And that is the second point: is further tariff escalation could drive new bouts of market turbulence in the fourth quarter. And that is certainly true, as we saw on Friday. And thirdly, equity valuations are very, very stretched. And for many investors, that is disturbing. For others, as long as growth is there, it's not as disturbing. But equity valuations are elevated versus 5 and 10 year averages, suggesting vulnerability to a correction if sentiment does reverse and fundamentals deteriorate. So that is certainly a tripwire that is out there. Bottom line, despite record highs, multiple tripwires threaten current market optimism. Investors should seek out discounted stocks with strong fundamentals. And that's partly what brings us here today, because we're highlighting some stocks that have really good fundamentals and have already more or less been tripped up and have come down in price. So Emma, I'm going to hand it over to you so you can start the introduction for our 3 beaten down stocks that could be ready to rally.
Awesome, Steve. Thanks so much. We've got 3 very exciting stocks for you guys today, and they do span a number of sectors and industries, giving you a nice platter of stuff to choose from. For folks that aren't familiar, the webinar chat is open. I will try to monitor it when I hand off back to Steve. So any inbound questions around how to navigate the platform, or maybe stock-specific inquiries, how to think about our quant system, we'd love to take the opportunity to educate you on that a little bit more. So please drop your questions in there. Starting off, our first and most highly rated stock is Willdan Group, ticker symbol WLDN. Willdan is an interesting company. It provides energy engineering and consulting services that really focus on helping utilities and cities modernize infrastructure. So the too long don't read is that this company is quite exposed to the AI energy transformation that is taking place and making headlines every day. Every day you're reading about data centers building power plants for themselves, et cetera, modernizing the grid is a wildly complex problem, and Willdan provides a sort of specialty expertise in that. They're, I would say, a mid-cap company, small to mid-cap company with a market cap of about 1.41 billion. They're currently rated a quant strong buy. Within the industrial sector, they're ranked 16th out of 619. And then within research and consulting services, 1 out of 39. So they recently posted a phenomenal earnings beat in early August that, included many record-setting metrics, but among them was a 31% revenue growth and 40% profit increase year over year. So a really phenomenal result that's contributed to a run up in late August. But more recently, we've seen them, pull back about 5% over the last month, and that is due both to profit taking, which makes sense given how much they've gained. That is actually they're up over 148% year to date, and I believe about 111% on a trailing 1 year basis. So it's intuitive that folks would want to take advantage of profits, especially following that stellar earnings result. To the right of the slide, we've posted a snapshot of what you'll see in the platform, and Steve's going to take us in there a few minutes. But this really distills some of the most important components of the quant system down into a single scorecard. You'll see our factor grades on the right, which rate investment characteristics on a sector relative basis. And it includes our three primary fundamental indicators, which are valuation, growth, and profitability, and then momentum and earnings revisions. We refer to those more as timeliness indicators because they're just taking in both price performance and how analysts are viewing the stock at any given moment. But something I'd like to call out right at the start here is when you're looking at the stock from a fundamental perspective, it's really improved from 3 months ago. So its valuation 3 months ago was a D, and it's currently rated a C. Growth was ranked B, now it's an A, and profitability was a C, and now it's a B minus. So checking for that improvement is something we'd really like to see, and it, of course, has some explanatory value when it comes to its performance. Timeliness indicators, it looks revisions have stayed the same and momentum's come off a little bit. I would expect that's from its more recent momentum indicator, the 3-month one. As I mentioned, they've pulled back. That's why it's part of this presentation. But and just some highlights there, and Steve will show you more in depth in the platform what this looks like when you look under the hood of those factor grades. But we look at growth, we see a 32% forward EPS growth. That's 290% above the sector median. So it's a really strong growth rate there. Key profitability metric would be a levered free cash flow margin. It's got a 9.49% levered free cash flow margin, and that's 43% above the industrial sector. And it is trading at 4x its trailing 12-month PEG. PEG combines two valuation indicators. It's price to earnings and growth. And that is currently about a 65% discount to the sector. So those are just some high level, three really nice statistics that explain, the fundamental strength of this company. And I think Steve is going to give you a little tour of what Willdan looks like in the platform.
Right. Absolutely. I will do that. So we're going to go to Willdan. All I have to do is put in the ticker symbol, WLDN. I've got it right there. And this brings us right to the stock page. So as Emma highlighted, the stock over the last year is up 108%. And actually, if you click on these various time periods, it will show you the percentage change. Year to date, the stock is up 147%. So many of you might be saying, is this stock truly beaten up? Well, you could see from the year to date chart, the high was around $120, and it has pulled back to $94. And it is starting to flatten out along this area here, which I find reassuring at this point that we're sort of doubling down and say, hey, take a look at this stock. But despite the fact that the stock is up year to date 147%, as Emma pointed out, when you look at the valuation framework, it is actually better now than it was 3 months ago. The stock was more expensive 3 months ago than it was now. And additionally, the growth is stronger now. So better valuation framework, stronger growth, better profitability. To me, this is kind of an ideal time to be looking at the stock. So what I'm going to do is I'm going to show you some of the underlying metrics that make up that A- growth grade. So when we click on growth, it will take you to our growth page. And you can see this is a straight A report card for this company in regards to growth. Whether we're looking at year-over-year revenue growth or forward revenue growth or EBITDA growth or EPS growth, across the board, these A's give you an instant characterization of how the company compares to other companies in the sector. And we make it very transparent. So if you were to look at the revenue growth year over year, you could see the company is growing at 13.8%. The sector is only growing at 3.63%. hence the A minus grade. So it's a very intuitive, very user-friendly system. If we were to drop down to EPS diluted growth forward, you can see it has a 31% growth rate versus the sector at only an 8% growth rate. So it's at about a 290% premium to the sector's growth, hence that A grade. So really a great report card, just a couple metrics that are weak, but overall, when we tally up all the various underlying growth metrics such as EPS, EBITDA, EBIT, and revenue, the overall grade is A minus. And again, when we look at that versus where it was 3 months ago, quite strong. Also, you will see for the rankings in regards to the industrial stocks, there are 619 stocks in the industrial sector. This company on our quant system ranks 16. But if you actually look at research and consulting services as an industry, it ranks number 1 out of 39 stocks. If we go to the valuation page, you'll see a little bit more red here, but one metric, and I should tell you that these metrics, we do score them, but the weighting on the score is not equal. Some of these metrics are more predictive than others in terms of contributing to the future stock price appreciating. So we know what those weights are because we've back tested them over many, many years. And one of the metrics that is very strong here is the PEG metric, which actually combines PE and growth together into one metric. So most of the other value metrics are reflecting a value, either trailing value or looking at forward using analyst estimates in there. However, what is great about the PEG is it takes the growth and basically a growth metric and combines it with the price over earnings. And being that it's at a B plus, you can actually say on a PEG basis, the company is at a discount to the sector by as much as 64%. So that is what helps to bring up that overall valuation grade. If we were to look at profitability.
Sorry, I just want to interrupt you real quick because we do have a question from Greg, and I thought if we're looking at the valuation, this makes sense. He's asking if we have a specific price target for the stock. Maybe you could talk about why that's less relevant when we look at this broader valuation framework.
Yeah, you'll find, thank you for the question, Greg. You'll find most quants don't really use price targets. It's something that is used by brokerage houses when analysts write research reports. And, they want to give people a sense of where a stock could trade up to. But, the truth of the matter is that stocks and valuations and growth rates change every single day. So to put a stagnant price target out there is not realistic, especially, when you have the market moving and you have sectors moving as well. And when you look at a company, really the best way to value a company is to compare the metrics for a company to its sector. And being that all those metrics change every day, that's why the quant system has a directional recommendation that's refreshed every day. It's because we look at the data every single day and all the changes that occur. So every day, a stock trades thousands of times. And with each trade, it's a new valuation vote for the stock. So it's really not a realistic strategy to have a price target out there because so much changes on the market on a daily basis, on a relative basis. So we do not use price targets. However, we do have a directional recommendation, and that lets you know that the stock is a strong buy compared to the sector, and you have the factor grades underneath, and those get refreshed every single day. So every day you know exactly where this company stands versus the sector. And since we provide the absolute ranking value, you can see where that ranking is as well compared to the sector. So I basically tell people, if a stock is a strong buy or a hold, you're in fairly safe territory with it. But if it's a sell, you know to sell. We don't use price targets because they're just not realistic.
Great, thanks, Steve.
And yeah, so I think with that, Emma will take us back to the slideshow and we'll go to the next company.
Awesome. Thank you. Just saw a question come through that asks if a recording of this will be made available. The answer is yes, likely tomorrow or maybe Monday at the latest. You can find it at seekingalpha.com/video hub. I will drop that in the chat as well. Okay, so our next company is Bluebird Corporation, market cap 1.81 billion, ticker symbol BLBD. BLBD is an interesting company. It's a leading US manufacturer of school and specialty buses. And they really specialize in low and zero emission vehicles, including electric, propane, and CNG powered models. And they have over 20,000 alternative fuel-based buses in operation. So it ranks 24 out of 619 within the industrial sector. While I recognize it's an industrial like Willdan, its industry is quite different in that it is construction machinery and heavy transportation equipment, and it is ranked 2 out of 29. So, it's struggled a bit. Renewed fears around tariffs as well as potential cuts to clean energy funding have caused the stock to retreat about 3.39% in the last month. The stock is up around 43% year to date. And it's, in addition to its fundamentals, which I'll explain in a bit, it's had a really great year, consistently meeting earnings and revenue expectations in 2025. It's also last quarter posted record quarterly results that gave it a nice bump in August. And that was really encouraged by its robust backlog and reaffirmed guidance for both top line and margin growth. So looking at a key profitability grade, we see its return on equity is about 66%. That's 429% above the industrial sector. In terms of growth, it's got a 36% forward EBITDA growth, again, about 424% above the sector. And then on an earnings per share basis, 78% forward earnings per share. So really nice near-term growth prospects. That EPS figure is 865% above the sector. I included, I've highlighted its momentum up 43% year to date, and I've also included its revisions grade. It has 5 FY1 up revisions in the last 90 days versus 0 downward. So kind of consensus amongst Wall Street analysts that the future earnings prospects for this company are really sound. And again, we've seen, a bit of the valuation grade diminish above there. But other than that, profitability is improved from 3 months ago, as well as its momentum and revisions grade. So again, steadily improving factor grades, investment characteristics. So a very positive sign for Bluebird.
Yeah, and Emma, what I'll do is I'll take us into the platform so we can look at a couple of those factor grades that you were talking about. So we're going to go to Bluebird. And as Emma mentioned, the valuation is a little bit more expensive now than where it was 3 months ago, but growth is actually stronger, profitability much stronger than where it was 3 months ago, A- now versus C+ 3 months ago. And the revisions grade is A+ versus C-. So I'm actually going to take us to that revisions report card. And we'll try that one more time. Let's see. There we go. So as you can see, it has the A+ grade for analyst revisions. And in the last 90 days, as Emma mentioned, 5 analysts have taken their estimates up while 0 have taken it down. So again, this sort of leans into a time-sensitive factor, indicating that analysts feel very confident about the company now and their ability to produce results. And as we can see in the last quarter, they had a really nice beat, coming in at $1.19 on EPS, which was 21 cents ahead of expectations. And on a revenue basis, they came in at $398 million, and they beat by $20 million. So really looks quite nicely in terms of the earnings. And I'm going to show you the earnings history here. And in fact, you could see this company has had probably about 2.5 years of solid earnings beats. So very consistent there. And I think that's very telling on what they have in the pipeline now as analysts are taking their estimates up and the confidence that is there. Another page that we will take a look at is the momentum. So to get to that, I'll go back to the main stock page. You can see momentum here in the factor card. And again, when we're talking about these companies being up, what's really important to keep in mind is how much they're up versus the sector. And that is definitely a sign of confidence that investors have in this company compared to the sector. So for the 1-year price performance, we could see the stock is up 27% versus the sector up 5%. And recently, over the last 3 months, we could see that the stock is up 33% versus the sector up 2.2%. Now, this, when you look at the momentum on a relative basis, you should not feel like you're really chasing the stock. when you compare it to the sector, it's telling you a story. Okay. The performance is superior to the sector because the fundamentals for the company are superior. And that's why the stock is above the sector. So, really keeping it in a relative comparison, it's an important way and strategy for your investment process is always to keep in mind how it looks on a relative basis. Emma, I'm going to take us back to our slideshow and you can unveil the third stock.
All right. And our final stock for today is a nice consumer staples pick. Again, nice way to diversify against those industrial picks prior. And it is Fresh Del Monte, ticker symbol FDP. It's got a market cap of 1.61 billion, ranked 8 out of 179 in the consumer staples sector. And then within its industry, which is agricultural products and services, it's 2 out of 13. So very highly ranked within both its sector and industry. And FDP is a global leader in produce operations. It's vertically integrated, so they control farming, shipping, marketing, and distribution. And it's global. I think it operates across 90 countries. They have a specialty in pineapple. That's something I read today. And they've retreated a bit, as Steve was mentioning at the top of the presentation. Though markets have been split, in terms of sector performance, we've really seen tech and some risk off lead over the longer term, and consumer staples has fallen out of favor. So it has outperformed the sector over the last year. It's up 12.45% versus the sector ETF, which is up 3.53%. But FDP has been beaten down about 6.5% over the last month. However, it does display really strong fundamentals, particularly valuation and growth. So in terms of its growth, we see an operating cash flow growth of 4.82% versus sector's negative 3.77%. Steve will obviously probably highlight more of those growth metrics when he goes in the platform, but standout valuation metric is its 12.44x forward PE. That's about a 33% discount to the sector. And then something we like about FDP is it is an income generating stock. Again, in times of uncertainty or potentially increased volatility, income generating stocks can offer the reliability of cash flows that some investors prefer, while also simultaneously offering the potential for capital appreciation. So its forward dividend yield is actually pretty good. It's 3.57%. When you consider that within the context of the sector, it's well above average. I've included a snapshot of its dividend grades to the right here. This is the first dividend paying stock we've introduced into this lineup. So for folks that are less familiar, we do provide, similar to our factor grades, dividend grades that are driven by the quant system as well. And they evaluate dividends across safety, growth, yield, and consistency. I imagine Steve will jump into these more when he takes to the platform, but I like all these dividend grades, particularly safety and growth. Really indicates that the stock is not at much of risk for the dividend being cut, with even some potential for it to grow. So that's the high level overview of FDP.
Yeah, I mean, I'd say that's spot on. It's, to find a stock that is a quant strong buy. And when we look at our quant factor grades, they're different than the dividend grades because for dividend, we're basically looking for dividend safety. We want to make sure that if a company has a good dividend grade, that it will not be cutting or reducing its dividend in any manner. When we look at the quant, we're really looking for capital appreciation. So quite nice to find a stock that is a quant strong buy that has a good dividend safety grade and a yield of 3.57%. I'll take us into the platform. And as you can see, we've gone over what the factor grades look like. I'm actually going to dive into the dividend grades here. So we'll click on dividend safety. And you can see it's a B minus overall, but there are a lot of different metrics that we look at for dividend safety. There's cash dividend payout ratio. There's free cash flow yield to dividend yield. There's interest rate coverage, which is an A minus for the stock. We look at debt as well, total debt to equity. So really good grades there for the most part. Company pretty much in line with the sector in regards to some of the profitability metrics, such as return on equity, cash per share. And then a couple other ones that look fairly strong are 60-month capital asset pricing, the percent of the security owned by institutions, the dividend growth rate, and dividend coverage, all very strong. So how important are dividend grades? Well, I'm going to show you. So this basically displays a back test that we ran going back to 2010, and we found by employing our dividend safety grades that 98.77% of dividend cuts were averted by owning stocks that had a dividend safety grade of A plus to A minus, and virtually 98% of all dividend cuts were averted just by having companies with dividend safety grades of A plus to B minus. So if you have a company, and you want to, if you have a stock that pays a dividend and you want to see the dividend safety grade, I absolutely recommend that you go to the premium platform and look at the dividend safety grades to see how your company ranks. And it is fairly important because we also have found, conversely, that 70% of all stocks that had a dividend safety grade of F had cut their dividend. So it's a fairly accurate system. It does a good job. It's not foolproof, but it does a very, very good job. And we actually also found that if you owned companies that were quant strong buys and had a dividend growth grade of an A plus, it outperformed the industry standard benchmark, which is the Vanguard VIG index, which is an equity and income ETF, but widely used as a benchmark for many dividend products that are out there. So just wanted to highlight the dividend safety grades and dividend growth grades that we employ. Take us back to our slideshow. And we will basically, I think, conclude the 3 beaten down stocks. This gives you a quick vision on the investment characteristics that we look at, being valuation, growth, profitability, EPS revisions, and momentum, as well as you can see the name and the sector that it's in. And if you are interested in learning more about this, we are actually publishing an article that will be out at 5 a.m. tomorrow called 3 Beaten Down Stocks Ready to Rally. And that will go into a bit more detail on all the stocks that we discussed today. So I do want to, before we conclude and take some questions, I do want to highlight there's obviously a lot of research on the Seeking Alpha Premium platform. We cover thousands and thousands of stocks. But part of what we do to make your life easier and provide you with investable ideas is we have investment research products that we've created for our subscribers. There are 2 products. One is called Alpha Picks. This is designed for long-term investors, and Alpha Picks produces 2 ideas every month. On the trading day closest to the first of the month and the first 15th of the month, we send out our top quant strong buys. And then we have another product that's a little bit more active called the Pro Quant Portfolio, which is part of our Pro platform. And this is an actively managed data-driven model that rebalances weekly. So as opposed to Alpha Picks, which just has 2 ideas a month, this actually rebalances weekly and has 2 to 3 ideas per week. And just to give you a little idea of what the performance is like, the Pro Quant portfolio was actually just launched in May of this year, and it is already up 41% compared to the S&P 500 on an equal weighted basis, up 7.2%. And Alpha Picks was launched about 3 years ago, and that's up 255% since inception versus the S&P up 76%. And year to date, Alpha Picks is up about 37% versus the S&P on a market cap weighted basis up 13.49%. So you see both products have had really excellent performance. And I think I pretty much reviewed the differences between the 2. Alpha Picks, again, designed more for long-term investors, just with 2 ideas a month. Market cap has to be above 500 million for stock to make the Alpha Picks portfolio, and we do not invest in stocks under $10. Pro Quant portfolio, it's actually an equal weighted portfolio of 30 stocks where Alpha Picks just goes on and on and on with new ideas. The Pro portfolio is limited just to 30 stocks. However, it does not have the same stringent criteria and parameters as Alpha Picks. So we look at all market caps for it, and we look at stocks across the world in the form of ADRs or US stocks, all market cap. So that's a little bit about the products that we have that are out there. So if you're interested, feel free to look into those, and we do the investment research for you on those products. Emma, should we take some questions?
Yeah, definitely. Because Steve just went over Alpha Picks versus PQP, we had a great question that dovetails the pro service really well. So we had a question that asked, is it possible to do a search for all the stocks that have turned into a buy or a strong buy today? So I believe the pro platform will include recent upgrades and downgrades. Maybe we could show folks what that
Yeah.
looks like if you do become a pro subscriber.
All right. So I will take you into Pro, and thank you for the question. And in fact, if you are on the Pro platform and you go to the navigation bar on the left-hand side, you will actually find one of the categories is upgrades and downgrades. That is one of the benefits, and that will show you all the stocks that were upgraded today to a strong buy from its previous position, which could be a hold or buy, or in certain cases, rarely a sell, but there are there. So mostly the sells will go to a hold before they go to a buy, but on occasion we can see a complete reverse. But this is a great aspect to the pro platform compared to the premium platform.
And then separately but related, we did have a question about the premium platform. I'm new to the platform and having a hard time finding your latest quant strong buys. Maybe we could show a stock screener that
Sure.
that lends itself to the quant strong buys.
So again, on the left-hand nav, we're going to slide down and we're going to go to stock screener. And you can see there are some pre-baked seeking alpha screens, or you can create your own screens. A couple choices here are all stocks, top rated stocks, top quant dividend stocks, and stocks by quant. So you could just click on stocks by quant, and you'll see that there are 4,300 companies that are covered by quant. And you can actually edit this if you just want to see the strong buys. You could go on the ratings, and let's see, quant factor grades. So we just have quant ratings there. Next, and that will show you all the quant ratings, but you could take them out. So we'll take out strong sell, sell, hold, buy, and just display the strong buys. Click done. And you can see that list of 4,000 plus has been reduced to 346 stocks, which are strong buys and ranked by strength.
Awesome. Okay, and then maybe this is a we don't need the platform for this, but I thought this was a good question. Why do you sometimes pick the second best ranked stock in a sector instead of the first? What's the rationale?
Good question. So, if we were on, say, top stocks, um, and I took a closer look at some of these companies, I might find that a stock actually has negative earnings, and it's very possible for it to rank highly, but not all subscribers are comfortable. And in fact, in Alpha Picks, we don't put in companies that have negative earnings. So often when we're recommending this through our articles or it's going into Alpha Picks, there are certain parameters that we include to make it a little bit more conservative. Where PQP is basically unplugged, it goes for everything that's in our quant model, whether earnings are negative or positive. For the articles specifically and for alpha picks, we will have parameters, and that will exclude companies that have negative earnings.
Awesome. And then we did have a question about how sector considerations play into our alpha picks. Maybe we could talk about the bottom up nature of the quant model and how that works.
Yeah, so the quant model, as Emma said, it is a bottom-up approach. So we're really targeting companies that have very strong fundamentals and not necessarily paying attention to what sector it is. Having said that, if we find with alpha picks that more than 45% of the stocks are in a certain sector, we will start pass overing those stocks as we enter them into the portfolio because we do not want the concentration risk to be too high. Now, you might even think 45% is too high, but the idea here is to generate ideas based on their data. But to put it in perspective, if you looked at the S&P 500 and you looked at the Magnificent Seven stocks, those are the top seven stocks. And at one point, I think they were 38% of the S&P 500 just in seven stocks. So you actually get more diversification in alpha picks than you would in the S&P 500 with that kind of concentration risk. Of course, we don't have 500 stocks, but that is a high degree of concentration risk in the S&P 500.
Great. Thanks, Steve. I think we can get ready to wrap up. I just got one question with regards to the Pro Quant portfolio. I may have missed it. Is there a call to discuss the portfolio changes on Monday? We have a bi-weekly call to discuss updates to PQP. We go over the buys and sells, major performance drivers of the portfolio, and any updates to anything that's going on there. So please keep a lookout if you are a Pro Quant portfolio subscriber for those bi-weekly webinars.
Yes, and I will add, if you are a subscriber to it, you get an email on a weekly basis. It's also, there's a platform set up just for the Pro Quant portfolio, so you'll find the articles there, you'll find the portfolios there, you'll find the performance there. So there's a great deal of information that's set up on a separate platform for the Pro Quant portfolio. But for Alpha Picks as well, it has its own platform where it provides all that information, from the analysis to the portfolio weights to the performance. So it's a very, very transparent system. We don't want to hide anything. So you see exactly the date that something's picked, exactly what the weight is, and the performance, whether it's good or bad.
Excellent. I think that's going to do it for today, Steve. Thank you all for your great questions and for taking the time to join us. I misspoke earlier. The replay of this will be available at seekingalpha.com/videos. I dropped it in the chat, so you should be able to find it there as well.
Thank you so much for your time today, everybody. And we hope that these investment tools and our platform helps make your investment decisions a lot easier. Have a great day.
Have a great day. Take care.